everybody, this is Swati Gupta, Chartered Accountant. Welcome to lecture number 13. This lecture is in continuation with lecture number 11 and 12. Here we will continue with Ind AS 115 provisions and the concepts. Okay. Now, as you know that there is a 5-step model for recognizing revenue from contracts with customer. Okay. Here in this lecture we will head towards step number 2. That is identifying performance obligation. Okay, what is performance obligation? It is a promise to deliver the particular goods or service, or a series of goods or service, or the bundle of goods or service. Okay, so it is basically the promise that has arisen due to the agreement between two parties, due to the contract between two parties. Okay, so you have to identify performance obligation. As you know, there can be one performance obligation or more than one performance obligation in a particular contract. So basically this step will guide you that how to identify performance obligation of a contract. Okay, firstly, an example is given. A Limited agreed to customer to build a water purification plant. A Limited is responsible for all the aspects of the plant. It is a whole package. Okay, A Limited is responsible for entire plant setup. That is overall project management, engineering and design services, its site preparation, physical construction of the plant and procurement of the pumps and equipments and integration of all the work. Identify performance obligation. Since there are multiple promises to deliver this particular goods and services. Okay, this particular service, there are multiple services and the goods, okay, in this particular contract. But these are whole negotiated as a one package. These are interdependent on one another. Okay, these are not separate, and therefore this total services and goods combination will be treated as single performance obligation. Okay, so this, for example, these 4, 5, 6, all these will be added and will be recorded as one plant. Okay, and one plant is being transferred to customer, and that's why one performance obligation, single performance obligation. Performance obligations under a contract with a customer are not always explicit or clearly mentioned. Explicit means clearly mentioning, that is while negotiating it is being laid down specifically. If yes, then it is known as explicit. Okay, if it is implied, then it is known as implicit. Okay, in the contract. But there can be implied promises. Which are not negotiated at the point of agreement, but these are deemed, these are implied. Okay, these are known as implicit or performance obligation under the contract as well. There can be explicit and implicit, both can be there. Okay, another example. A Limited enter into contract with customer to provide broadband services along with voice call. Customer buy modem from an entity. However, customer can also get connection from entity and modem from another vendor. Means that these are not dependent on each other, that you have to buy modem and the connection from one company. No, you can buy the modem from another vendor and you can buy the connection from another. Okay, so there is no interdependence. It is not negotiated as a package. There is option given that do you want voice call, do you want modem, do you want our connection. Okay, so these are separate performance obligation, because these have a capacity of delivering on its own. Okay, these are not at all interrelated, or you can say interdependent. The installation activity requires limited efforts and insignificant cost. Okay, we will read another concept right now in this lecture itself. Okay, when do we classify it as a separate performance obligation and when do we consider it as single? Okay, right now, since the efforts of this installation are not significant, will not entirely majorly impact the whole project, okay, whole contract. So these are insignificant, not major one, and the entity or the customer has full freedom either to purchase broadband or voice call or modem. Now, therefore, these all will be treated as separate performance obligation, Okay. Next, example number 3. An entity enters into contract with customer to build power plant. Entity is responsible for the project management, site clearance, foundation, construction, installation and finishing. As per the previous example number 1, you know that these all activities will be combined and treated as one particular performance obligation. Okay, it's alright. What's new in this example? See further, entity is also responsible for all maintenance up to 5 years. There is a separate service of maintenance being promised. Okay, there is a separate service being promised up to 5 years. So there will be separate performance obligation. Construction of that particular power plant is one performance obligation and delivering the same. Secondly, the 5-year maintenance service is separate performance obligation entirely. Okay, 2 performance obligations. Next, example number 4. An entity enter into a contract with customer to provide 5-year service at agreed consideration of rupees 1 crore. Evaluate. Simply 5-year service is there. If it can be terminated or it can be terminated okay, and needs to be reevaluated, then you have to classify it as every year 5 performance obligations. Okay, if there is a clause, for example, that at every year end you have to reassess that will it continue or not. Okay, if such is the case, then you will record each and every year as separate performance obligation. Okay, but here it is provided 5 year and there is no termination clause and all, therefore it will be treated as one particular performance obligation. Next, explicit and implicit promise. If it is laid down clearly at the time of negotiation, okay, then this is known as explicit. Entity promises to the distributor to provide maintenance services for no additional consideration. It has been claimed, or you can say promised separately. Okay, separately, but with separately, or you can say instead of separately you can say expressively. Okay, you have expressed such particular clause at the time of negotiation. Okay, I won't say separately, instead it is along with the same contract, but it has been negotiated, it has been laid down while the agreement was being done. Okay, now for no additional consideration, that means it is included, but since explicitly, or you can say expressly, it is expressed separately while at the time of negotiation, it is known as explicit. If it is not shown or discussed at the time of negotiation, it is implied that particular performance obligation exists or does exist. Okay, then this will be considered as implicit promise of service. For example, the entity has historically provided maintenance services for no additional consideration. This is what? This is business customary practices, due to which it is implied that for years it has been doing this. For if whenever you purchase Hyundai car or Honda car or any other company car, okay, there is specific terms and conditions. Okay, at times a particular Hyundai gives you 2-year guarantee, 2-year maintenance services free. Okay, next 4 services free. If such is the case, then this is implied due to past business customary practices. Okay, so expressly told, then this is explicit. If not told but is deemed, then this is known as implicit. Okay, I hope I am clear. In case of doubt or confusion, if I have added any confusion, please let me know. Okay, comment down or chat with me. Download the app. Okay, performance obligation. Next, it is defined as a promise in the contract with the customer to transfer the customer either a good or service, as you know, or a bundle of goods and services, or distinct goods and services. Okay, have same pattern of transfer to the customer. Entity is required to treat series as a single performance. This is very important. if there is series of goods and services that are being transferred, such series will not be bifurcated separately. Instead, the whole series of transfer of such goods and services will be treated as one performance obligation. Read it again. The entity is required to treat the series as a single performance obligation. That is, it is not optional. One more additional point, any administration work related to service is not treated as separate performance obligation. Okay, it is not treated as separate performance obligation. Any administration work, for example, you are required to manage and administer the particular project, then such administration will not be treated as performance obligation. Why? Because it cannot be done separately. It cannot be separated from entire contract. It is an integrated part. Okay. Next, distinct performance obligation. Okay, distinct means different. When it will be said that a particular performance obligation is distinct, very important. Please note it down. Okay, goods and services promised in a contract is distinct if goods and services they have a capacity to get benefit either on their alone or with the available resources. They have capacity to get benefit from their own, or can be used from their own or with the use of available resources, and separately identifiable from other promises in the contract, then it is known as separate performance obligation. Now, for evaluating distinct performance obligation, very double star it. Okay, if you are a student and learning for ICAI exam purpose, this is very important for solving questions as well. Significant integration services. If there is significant integration of services, that means what? Significant modification or customization, highly interdependent or interrelated. If yes, then it will be treated always as one performance obligation. Okay, no distinct performance obligation, instead one performance obligation. If it is not significantly integrated services, okay, or the modification or the installation or any other service part, it does not create a major impact, okay, then it will be included. If it creates a major impact and it entirely changes the original asset or service, then this will be treated as separate performance obligation. Okay, it will be treated as distinct, can be differentiated very easily. Thirdly, if it is highly interdependent, then it cannot be separated. No distinct goods and services, no distinct performance obligation. But if it is not interrelated, it is highly independent, not dependent, then it can be, if it is highly not dependent, okay, not dependent, not interrelated, then you can consider it as distinct performance obligation. Highly dependent, then you have to consider it as one and cannot differentiate. Okay, distinct means, in easy words, you can say can be differentiated easily, can be separated, differentiated easily. Okay, differentiated easily, can be separated easily. The fact that the entity regularly sells a particular goods or service on their own, okay, they are able to sell a particular goods or service on their own without any other use, okay, regularly sells, this means that, this shows that the particular good or service is distinct on its own, okay, because it has a capacity to be used on its own. Therefore, the particular entity is successful in selling a particular goods and services or without any dependence. Okay, next, allocate based on relative standalone prices. Okay, now there is a transaction price, you have to allocate such transaction price. This is step number 3. You have identified contract with customer. Secondly, you have identified the performance obligation. Okay, now next step comes is that you have to identify the transaction price, and then after that divide this transaction price, allocate this transaction price to the performance obligations. It can be done in multiple ways. When there are multiple performance obligations, when there is more than one performance obligation, such transaction price will be allocated to all the performance obligation. How come? There are multiple ways. If it is observable, okay, if it is directly observable, for example, there are 5 products, okay, product number A or product named A has separate amount, okay, separate transaction price. Since it is separately directly observable, it will be charged with that particular transaction price, okay. But if it is not observable, then you will have to apply some techniques. Those are firstly adjusted market assessment. It is adjusted market adjustment, okay. This means that whenever an entity is selling a good that is also sold by other entities, if any particular entity is providing services which is also provided by other similar entities in the market, then you will be applying adjusted market assessment approach. Adjusted market assessment approach is used only and only when there are similar goods and services being traded on regular basis by other entities. Good. Second comes is cost, expected cost plus margin. Whenever the good is new or the service is entirely new, okay, and it is not being traded normally in the market by different entities, then you cannot take market price, and thereby what you need to do, you need to follow expected cost, that is of your own cost, plus the margin that you are intending to add, and the amount that comes is your portion of the transaction price. That price is attached to that particular product or service, okay. Next and third step comes as residual approach. This means what? That for example, there is five products are there. For example, 5 products are there. Product A has been, since it is easily sold and traded in the market regularly, you have applied for product A this estimated approach, okay, adjusted market estimated approach. Now next, for product B, since it is not available and new product is there, you are applying expected cost plus margin method. Nothing, no worries. But for the remaining 3 products, what you need to do, you need to follow the residual approach. You need to separate out this 3 transaction price, the transaction price, the remaining transaction price, and allocate on residual basis to the remaining performance obligations, okay. You will get to know this better when we will read the question answers of ICAI, okay. So don't miss out that. In case of doubt, please ask me. Next comes is promise to transfer series of distinct goods and services, okay. What is performance obligation? To transfer goods and services. When entity agrees to provide customers series of distinct goods and services, then such series shall be treated as single performance obligation, as one performance obligation. Did you know this? Yes, we have learned this in the particular lecture itself. If customer has choice to terminate, very important, if I told you that if there is a 5-year maintenance contract, don't worry, record it as one particular performance obligation, single performance obligation. But if there is a choice to terminate at the year end, at every year end, then each year end, each such year will be treated as separate performance obligation. Next, multiple element arrangements. Multiple element arrangement means what? That if it is bundled or not. If can be unbundled, then separate performance obligation. At times the particular good or services is combined in such a way that it cannot be separated. If it cannot be separated, it is bundled naturally, then you have to record it as single performance obligation, okay. For example, machine and compulsory installation, okay. At times you are purchasing AC, and for example you have purchased it from IFB company. That company charges you 40,000 rupees for that AC and says that the installation is included, okay. Even if you do not get it installed, nothing will be deducted. If you get it installed, nothing else will be charged, okay. If they are saying that machine plus compulsory machine, or you can say that particular equipment plus the compulsory installation is a part of the contract, cannot be separated, it will be treated as single performance obligation, okay. If it can be separated, then it will be treated as separate performance obligation. It depends on case to case basis, okay. What is the particular transaction nature? Next, customer option for additional goods and services. If such goods, services that are being provided at the additional discount, if it is material, then separate performance obligation will be recorded. If it is not material, then single performance obligation will be recorded. Material over here means that right that provided additional discount. If such right is material, then separate performance obligation. If such right is immaterial, then a single performance obligation. Okay. If it is material, separate performance obligation. If it is not material, single performance obligation. Okay. Example: A Limited provided customer discount coupon of rupees 1000 with products sold for rupees 10,000. Okay, 1000 rupees have been provided for rupees 10,000. Is it material amount? Is it a good amount, large amount in comparison to 10,000? 10% amount. In market, company does not offer any discount. However, in the market on regular basis, it is not providing any such discount. How many performance obligations are in the contract? Since it is material, then separate performance obligation. Since discount is material, then separate PO. Then such discount will be treated as separate performance obligation. Okay. Other than that, long-term arrangement, contract cannot be terminated. If it cannot be terminated, I told you 5-year contract, then single performance. If it can be terminated, then at each year end or renewal, you have to record each year as separate performance obligation. Okay. Next comes consignment arrangement. Very important. Okay. The consignor, that means somebody who is transferring goods and services to the agent or consignee. Okay. On behalf of that, agent works. Consignor or consignee is the person who is taking or collecting from the one party and transferring it to another party. It is just the transporter, the mediator. It is just working on behalf of both the parties, receiving from one and selling it to another. Okay. Now, if there is any consignment arrangement, okay, the goods are transferred to the consignee, that means that particular agency that is working on behalf of the party, the client. Okay. Now, if all the risk and rewards have been transferred, if control has been transferred, risk and reward have been transferred, okay, then only you will be recording it as then only revenue will be recognized. If the control is still being possessed by the consignor itself, it is being possessed by the party itself, then such transfer will not amount to recognition of the revenue. It will record revenue only and only when it is finally transferring either to the customer or finally transferring to the consignee, but whole control has been transferred. Now any surplus or any risk or any reward will not be transferred to the consignor. It is whole soul of the consignee. If this is the case, if control has been transferred, if risk and reward have been transferred, then only you are in a position to record revenue, otherwise not. There is a very good example in ICA module that one is transferring goods to the consignee, okay, but it will be sold to the final customer. On every sale, they will be offered 10% or rupees 10 extra commission. So, still it is not sold to the final customer. It is, and the consignor has whole rights to ask back the remaining stuff. Okay. So, consignor is having all the risk and rewards. It has not transferred the ownership, the control. Therefore, it will not be treated as, it will not record the revenue. It will only record the revenue when it gets finally transferred to the customer. Okay. Control is transferred by the entity to consignee. Goods sold by the consignee to customer, either sold to the customer or control has been transferred to the consignee. These are two cases only and only when the revenue will be recorded. If we talk about sales return, is not treated as consignment because in case of sales return, control of goods is at customer's option. Okay, since control have been transferred to the customer, but now if it is returning, it is on the say of the customer. Now there is no say of the seller. Okay, it is done on the choice of the buyer. Therefore, revenue can be recorded for the sales return. You will not be considering it as consignment. Okay, that's all for this lecture. We'll continue the later part of Ind AS 115 in the next lecture. Okay, for full videos, lectures in Hindi and English, both languages, and PDF notes, don't forget to check out the description box. This is Swati Gupta, Chartered Accountant. See you in the courses. Till then, take care, be safe, stay tuned.